Welcome back. You're watching The Money Show on ET Now. It's time for our Meet Your Fund Manager segment. And today we've decided to talk about the Canara Robeco Emerging Equities Fund. It's delivered around a 60 to 65% in the last 1 year. And even in the last 3 and 5 years, extending the time horizon a little bit, it's managed to deliver a return which has been in the teens, which is very impressive. Let's bring on board now a very special guest to talk about this fund, the strategy it deploys, and of course to talk to the unit holders of the fund as well as potential unit holders. Shridatta Bhandwaldar, the head of equities with Canara Robeco Asset Management Company, joins us now on the show. Thank you so much, Shridatta, for taking out time and speaking with our viewers today on ET Now. To start with, tell us a bit about the Canara Robeco Emerging Equities Fund. The name suggests emerging equities. One's mind would immediately shoot to, okay, perhaps it's looking at, the small caps, the mid caps with a lot of potential. So tell us, what do you look at? Where does the fund essentially invest?
Canara Robeco Emerging Equities scheme, as you rightly mentioned, actually invests in emerging businesses. And emerging businesses characteristics is more important. So focus is more on growth. So while you're right, along with large cap, mid cap and small cap is a larger focus as far as the fund is concerned. But it is kind of a diversified fund with 50 on an average, about 50% in large cap and 50% in mid and small cap. Having said that, how we internally characterize the fund is that this is a wealth creator fund. This is a fund which invests in growth businesses. At all point in time, we look at growth as a key characteristics when we invest in any company, particularly for this fund. So that's the core strategy of the fund.
Okay, so growth is where the focus is for the Canara Robeco Emerging Equities. You mentioned that there are, large caps, small caps, and mid caps. So what is the split like? Is it dynamic? If you could just share with us, how do you split the composition of the fund across the different market capitalizations?
Sure. Of course, it is dynamic contextually based on where the growth is residing in that particular macro environment or micro environment. If you look at, say, last 3-4 years, probably growth was more residing in large caps, whereas last 1.5 years, the growth is actually more broad-based. And to that extent, accordingly, the weights will move. But on a normalized basis, typically the fund has about 50% large caps and 50% mid and small caps. So that's the broader construct of the fund. And then it goes on either side, depending on where the growth, earnings growth opportunities are there on bottom-up basis.
Okay, what are the key parameters you look at? I know you mentioned growth being one of the key ones. So wherever you see the potential for good growth, you accordingly rotate your stock and sectoral allocation there. But apart from growth, what are the other parameters you look at before deciding whether a particular stock should enter your fund or not?
Sure. So let me take you to the broader house construct for us at Canara Robeco. So typically, you have two parameters, which is first is basically the kind of business you are investing into. So first is the business hygiene check. Then second is, of course, the promoter quality. So business quality as well as promoter quality, these are the first two filters through which the stocks are run. And then at the fund level, as I said, this fund is a fund which focuses on optimal risk-adjusted wealth creation over a period of time, and that's where growth comes in picture. So once the quality of business and quality of management is acceptable, then what we move to is which are the spaces which are offering you growth, earnings growth. And so when you look at growth, it doesn't have to come from necessarily only the sectors which are growing. So of course, that's one space. So there are sectors where the growth is there. So naturally, you will have a lot of positioning there. Then you have companies within sectors who are gaining market share at the cost of others. That's another. And then there could be spaces where there is a profit pool which is migrating from one set of companies to other, and that is offering you growth. So once the first two parameters or hygiene check is done in terms of the quality of business and the quality of management is acceptable, then what goes into the fund is which are the companies, sectors, stocks which are offering above industry average or above market average earnings growth for next 2-3 years, and that goes into the portfolio. So that's the broader thought process as far as the fund characteristics is concerned, or what the stock selection is concerned. At the same time, so clearly the natural corollary is since growth is the focus, then you would have a lot of sectors like typical utilities, value sectors, where typically growth is slow, and those will naturally not go into this fund strategy.
Understood. Now, we've spoken about, the parameters that you look at when you are entering a fund. But let's talk about ensuring what stays out of the fund as well. And I think in the last couple of years, that too has gained prominence. In the past, about a few years ago, we have seen many fund NAVs, deteriorating on account of the fact that there was that one or two bad apples that have really pulled down the NAV of the funds. While, of course, it's been more a problem of the debt side, in equities as well, it's done a fair bit of damage. So what kind of stocks would not get an entry into the fund?
That's an interesting question. Thank you for asking that. That's very critical for us as a house. So as a house, we are very, very conscious about what kind of balance sheets, managements, and business quality that we get into. And that gets decided while creation of the universe of stocks itself. Having said that, when it comes to this particular fund again, the businesses who have very high leverage, the businesses who have consistent negative free cash flows, the businesses, as I said, who have low growth profile as a sector or companies, the businesses where promoters' capital allocation has been under question, or the promoters where the integrity of the promoters is under question, all those businesses, basically balance sheet related challenges, growth related challenges, and promoter related challenges, if I have to summarize it, those stay out of this particular portfolio.
All right. Okay. I was just looking at the construct of the fund, and we noticed that you're heavyweight in banks and financial services as well. So what makes you optimistic about that? Tell our viewers about these sectors.
So as far as financials is concerned, there was one part of financials which was private financials, as well as insurance companies. That was the part which actually have done, or retail banks, if I can further classify it. Those are the spaces which have done well over last 3 years. But if you actually exclude that particular space, rest entire banking sector, and particularly as the names which we used to call as corporate banks, all those have gone through basically a corporate credit cycle, as well as credit growth decline over last several years. Now, if you look at what is happening in the sector, is that with the macro cycle likely to turn, you have growth coming back, you have balance sheets in place, you have liabilities getting concentrated in the hands of few names, large names. You have again asset book getting concentrated in the hands of basically few names. So clearly, you have balance sheets in place. They have come out of credit cycle. NPA cycle, in our view, for all practical purposes, is largely done unless until we get massive COVID-3 and COVID-4, something like that. So credit cycle is behind and growth is ahead. And on top of that, you have profit pool actually getting concentrated in the hands of those 8-10 names, as compared to a very diversified set of banks and NBFCs doing well in the past cycle. And that's where, if you look at the names, those are the 8, 10, 12 names where we think that growth is returning, ROEs are returning, and credit cost cycle is behind, and that's why we are constructive on those names.
Okay. Well, coming back then to a bit more from the retail investor's perspective, what would you say is the riskometer of this fund? And that brings me to the question of suitability as well for the fund, because all your potential unit holders as well watching would want to know that, okay, I'm interested in this fund, but then of course when you buy a mutual fund, it's got to do with your own personal profile, your own risk profile, etc. as well. So what do you say is the riskometer, the risk profile of this fund, and what should be an investor's time horizon when they invest in the fund?
Sure. So clearly from SEBI perspective, this is on riskometer, it is on higher side. Clearly given that it is mid-cap, small-cap heavy portfolio or mid-cap heavy portfolio at least. So you have about 50% mid-cap naturally. So from risk profile perspective, the investors clearly who have at least 3 to 5 year horizon, okay, are the investors who should actually invest in this fund. Other factor is given that it has about 50% mid-cap. So I wouldn't say risk, but the volatility of the fund will always in short term be higher, and that's where I think that 3 to 5 year horizon minimum is what investors should look at when they invest in this particular fund.
Okay.
And even at our end, when we are
so any sectors then that you would rather avoid at this juncture for?
Sorry.
Go ahead, complete your point, Shridatta.
As far as avoiding sectors are concerned, there are no clearly no. It is more a function of what is happening to growth of those sectors, what is happening to the balance sheets of those sectors, and factually, if the earnings growth is in place and if the balance sheet and management quality is acceptable, there is no sector which is no clearly. Of course, from current portfolio stance perspective, relatively low growth sectors like utilities or staples or oil, fossil fuels, those are the segments where the portfolio is underweight on. But largely it is to do with the lower growth profile of those sectors in the context of the growth availability in the other parts of the market.
Okay. Now, finally, Shridatta, you've got a lot of your current unit holders watching, prospective unit holders watching as well. So any message to them on, the future promise that this fund shows, given its investing theme, what would you like to share with them? So
I think the message is very, very simple and insightful, if I can actually boast about it that way. Is that we are focused on identifying growth stocks as far as this fund is concerned. We are focused on actually avoiding weaker balance sheets and weaker promoters. So to that extent, they should expect optimal risk-adjusted return and wealth creation over medium term, which this fund has also kind of delivered and proven in the past 10 years. And that's what they should expect for future. Clearly, again and again, I keep reminding this to investors through all our interactions, is that spending time in market is more important than trying to time. So keep investing in this fund and the others in equities as asset class through SIP route and enjoy the fruits over a long period of time.
Okay, well, Shridatta, thank you so much for joining us and talking to us about the Canara Robeco Emerging Equities Fund, giving us such a deep dive and a great introduction to the fund as well.
Thank you. Thanks for having us on the show.